My next guest says a strong economy doesn't necessarily lead to a bad stock market unless runaway inflation emerges, which is not the case right now. He highlights a few sectors he likes and others he does not. Scott Ladner is the Chief Investment Officer at Horizon Investments, and he joins us now. Good to see you, Scott. Good morning.
Hey, morning, Mark.
All right, so the Fed decision in December is in the rear view, of course, but it's probably worth revisiting because I noticed in your notes that you're definitely talking about it and how it has sort of changed the calculus, so to speak, for investors in the markets in general. So the Fed, you say, has introduced some uncertainty. There's concern about inflation. They think the risk is to the upside. And they've also added to their calculus, to use that word again, what incoming President Donald Trump may do in terms of immigration and tariffs. So how has that changed the landscape, and how has that changed the investors' mindset in terms of the Fed?
Yeah, Mark, I think this is fairly important and somewhat unappreciated right now. Look, the Fed, the Fed calls themselves apolitical, and I think typically they had been, but it's really hard to kind of square that statement with what happened with the December meeting. And primarily what I'm talking about is, in September, everybody, pre-election, the entire Fed essentially viewed the risks to inflation as broadly balanced. Then after the election, the first meeting after the election, basically the entire Fed views the risk to inflation to the upside. Nothing changed in the economy over those couple of months. We didn't really get hot inflation prints. We didn't get anything that was very troubling. Labor market has been stable and sort of static here in the U.S. Really, the only thing that happened is the election of Trump. And so that shift towards the Fed essentially viewing risk to inflation being to the upside is basically the result of some people at the Fed trying to incorporate Fed potential Trump policies like as you mentioned, tariffs or immigration or anything like this into their forecasts. And the problem with that is that it does kind of stink as being somewhat political, but we also don't know what these policies are going to be yet. I mean, Trump says a lot. We all know that Trump says a lot, but Trump's what Trump says isn't always what actually happens. And so to incorporate some of these forecasts into your outlook, from the Fed standpoint, is really sort of confusing the market a little bit. And bringing back wisks into 2022 when inflation was the major problem. And so that's what's kind of spooking folks right now. I don't think it's going to end up being a long-term issue, but it has certainly been the issue for the past month.
And do you think partly, Scott, what's getting priced in is the outside possibility or maybe inside possibility of the Fed ultimately this year raises rates?
Yeah, that the market is pricing that right now. I mean, it's a non-negligible chance that the Fed's going to raise rates sometime this year is basically inside the options market in the U.S. We don't think that's very likely, frankly. I mean, what we don't have is a runaway inflation problem. We have a disinflation, situation that is going on right now and being fairly slow and bumpy, but we're not seeing inflation reaccelerate in any sort of meaningful way across any sort of metric that you want to look at. And so, whereas 2022, the big issue was, we didn't know where the top was on inflation, and therefore we didn't know where the top was on either rates or where the Fed was going to go. There's just a ton of uncertainty in terms of what's the max, what's the ceiling. I don't think that's the issue today. The issue we're grappling with right now is, we've got disinflation or progress towards the 2% goal, which is slowing and is a little bit bumpy, but we're not having it reaccelerated. And we're really kind of arguing about, is the Fed going to cut once or twice this year? Not really that seriously yet about whether the Fed's going to start hiking again, because that would only happen in the face of inflation reaccelerating again.
Okay, Scott, let's get to some of the sectors you like and some of the sectors you want to be underweight or avoid entirely. Starting with technology, it's still going to be a winner this year. What are some of the risks?
Yeah, look, this is, as my kids would say, AI is him. This is still the real deal in terms of tech. You got to play this game just like you did 25 years ago with the internet PC revolution. These productivity gains are going to be massive, and the big companies that are producing these material, these systems and going to be selling it and using to enhance productivity are just have the biggest margins in the world, and they're only probably going to get bigger. So the tech game is one you've got to play. You can be cute if you want to be overweight or underweight based on valuations or anything else, but you've got to participate and not try to time it too closely. The risks really are if we get a massive surge in rates and you get kind of a sell-off like you did in 2022, where future cash flows get discounted at a higher rate, therefore they're worth less. Again, we don't see it as a massive risk, but that would be kind of one of the chief ones if it's out there.
And then you like financials. We've heard from a few of our guests that it could mean a Trump administration could mean easier regulations, maybe some more M&A that will be allowed. Would you agree with that?
Yeah, look, that's kind of the classic view. We don't see any reason to come away from that. We know that there's going to be a lighter regulatory touch with the Trump administration coming in. We've seen this movie before. We know how he acts with big banks, both big and small banks on the regulatory side. And so we do think there's probably going to be a better play in the smaller banks because we do think the big banks are going to need to gobble some of those guys up. But overall, financials is a reasonable place to be for the first time probably in about 5 years.
And then in terms of a sector you'd note, like I'm just looking at your notes here, consumer staples, it relates to inflation and growth as well. You don't care for it right now.
Look, yeah, I mean, staples, I don't think you lose money in staples necessarily, Mark, but for staples to work on a relative basis, you've got to have one of two things happening. You either have to have a fair amount of inflation, or you've got to have a recession or really slowing growth. And we don't think we're going to have either one of those issues right now. So I think like staples are probably a reasonable place to kind of park money. But if your goal is to keep up with something like the SP 500, we think that they will lag because we're still going to have pretty strong nominal growth. We have some inflation, but not outstanding inflation. And so it's it's just one of those that probably doesn't keep up in what should be a reasonably decent year for U.S. stocks.
Thanks for your time today, Scott. Have a great day.
Thanks, Mark. Appreciate it. You too.